Okay, my favorite one, Alibaba. So I've never seen a situation where the price was so disconnected from the fundamentals for such a high quality business that had a meaningful moat. This reminds me of Microsoft in 2013 before it took off on a historic run. So everyone knows Microsoft. Well, Microsoft went through a period after the antitrust stuff where it basically traded sideways for most of the 2000s. The interesting thing about that sideways period, the stock did nothing, okay? So you're saying, wow, they must have had a rough patch. You know, sales must have been kind of flattish. You know, Ballmer missed mobile. Like, how could you miss mobile? He didn't get mobile right. He didn't get anything right. Except, over the 7 years when the stock price did nothing from 2006 to 2013, revenues were up 112%. That's in 7 years, 112%. It's not the fastest growing company in the world, but you wouldn't have thought. Huge Microsoft, 112%. Cash flow per share was up 193%. 7-year period. Stock price did nothing. Actually, this is the period. Stock price did nothing. Cash flow is up 200%. Imagine if you owned a business. Imagine you owned an apartment building, okay? 2,000 units. You've raised rents by 200% over 5 years. Over 7 years, you bought the building let's say you bought the building 7 years ago for $10 million. You've raised rents by 200%. Your cash flow is up 193%. Expenses have gone up a little bit. And someone comes in and says, I'd like to buy your building for $10 million. Wait, I bought it for $10 million. My cash flow is up 200% from when I bought it, and you're offering me the same price that I paid for it? And that's exactly what happens in the public markets for public companies. And that's exactly what happened with Microsoft. So, it's kind of like a balloon submerged underwater. You can hold it down so long, but eventually price catches up with earnings power and cash flow. It's just an economic arbitrage. And what happened here over the next 7 years, Microsoft returned 1,500%, which was a CAGR of 36% a year since 2013 when I wrote this. It may be even more. So this is a better example. This period from this period from this period, stock price did 0, revenues up 100, cash flow up 193, earning. So you see the levels of this euphoria, despondency. Where were we here? Despondency, right? No movement in price, huge movement in economics. By the way, over the next 7 years, when the stock went up 1,500%, the growth rate collapsed relative to this. So the market's a discounting mechanism, okay? And it worked on a lag basis, and that's that. So Satya Nadella is given a lot of credit, but don't underestimate what Ballmer created before Satya took the reins. Ballmer laid the groundwork, Satya took the reins. That's why people say, like, oh, when Republicans are in power, the market does worse, and when Democrats are in power, or vice versa. Look at what foundations were laid the 4 years before. Well, first off, I don't think politics ultimately has that much to do with the market. Although everyone thinks it and trades on it, fundamentally, all that matters is this. These are the numbers that make the stocks do this, okay? Now, why am I spending so much time on Microsoft? Because, got it? It reminds me a lot of Alibaba. So for the last 7 years, here's where we're at. This is a little bit old, but it's the same price basically. It's traded between 100 and 120 for the last, since June, give or take. Okay, and basically from IPO to 2022, revenues are up 894%. Cash flow per share is up 559%. Earnings per share up 600%. Share price is up 0%. Okay? Very much like what you saw with Microsoft. Now you can say, but politics. Why do you think Microsoft was trading so subdued? But politics, right? Antitrust, they got off track. People were worried about government regulation. They had to fight that whole thing out from 2000 to 2005. Same exact situation now. The difference is the politics have shifted in the last 3 months. And for the first time in history, the Chinese government has said, we usually re-stimulate an economy through infrastructure investment. This time we're going to do it a little different. We're going to put all of the stimulus into consumption. And what Alibaba is a toll taker. If you're going to consume anything in China, you're going to pay a toll. Like to get over the Brooklyn Bridge doesn't have a toll, but the George Washington Bridge, I grew up in Jersey, has a toll. And all the consumption that's going to be done in China over the next 2 years, and by the way, the government set a 5% GDP target for this year, I think that's conservative now with the opening, is going to come through Alibaba. So all the foundation that has been laid over the last 7 years with no benefit to the owners, as this goes into the next phase, I think we're going to see a monster benefit for the owners moving forward. Next. This is the Hang Seng. Last time the rubber band got stretched this far, relative to the rest of the world, it rebounded 156% over the next 17 months. This means many of the individual stocks in the index were up 200 to 250% over the same period. So this just shows, we're going to show how when the Hang Seng, which Alibaba is a big weight of, one of the top weights, trades down below book, what happens to the indices over the subsequent 18 months or so. This shows Alibaba's PE multiple over time. So again, this is a despondent multiple. We know the intrinsic value. The business has grown orders of magnitude, the price has not grown. So we know there's an untapped intrinsic value there. Currently trading at 11 times next year's. We'll see what they guide next week. But I think next week's earnings, remember the quarter was shut down, fourth quarter. So that might be your last opportunity to buy in the mid-90s in our view. And then kind of from there, it's off to the races over time. So, and by the way, that multiple 11.5 compares with this historic average multiple of 28 times. But everyone went through the door last year. They couldn't get rid of it fast enough. Why? Delisting, which you can own it in Hong Kong, all the other noise, Xi Jinping. By the way, I thought the one thing Michael Burry said, which I don't, he generally is pessimistic, but he said something brilliant. Everyone was worried about Xi Jinping as it relates to Chinese equities. And he said, meet the new boss, same as the old boss. So, while Baba's up 300%, 200% before it came down, Xi Jinping was still running the show. So it's kind of noise. It's the cyclicality. You pay attention to the intrinsic value of the underlying business, over time, that's where you win. But when Hong Kong, Hang Seng is trading below book, what happens historically? 1998, Hang Seng is up 156% the next 17 months. 2008, 110%. 2016, 82.5% in 23 months. And 2020, 35% in 11 months. Now, you're like, 35%, 80%, what's the big deal? The big deal is, that's the indices. Imagine if the S&P 500 was up 156% in 17 months. What do you think some of the underlying components do, like the major weights? They're up 200, 300, 400%. Even in the case of a 35%, you have tons of stocks in the index that are up 100, 150%. And the key is buying the ones that are most undervalued relative to intrinsic value, that are quality businesses, not what businesses. High quality business, cash generative businesses. We do the boring, stable, steady stuff versus the high flying stuff. It's just not our nature. But the high flyers, those guys can kill it too. Just not my skill set. Okay, so this just gives you an idea of the magnitude of these. Oh, by the way, so just to reemphasize that, so what happened 2016? So the indices were up 62%. This was the Hang Seng when it traded below book. 62. What did Baba do? 234. 234 is much better than 62. So you get that same euphoria versus despondency theme that I've been talking about. And I think we're close to the end here.